self-directed IRA versus the solo 401k plan. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. Welcome to another episode of AdBits. Today's podcast, I'm going to dissect and explain to you the differences between the two most popular self-directed retirement plans, the self-directed IRA and the solo 401k. And I'm going to make it super easy and simple so you can now fully understand the differences and what is the best plan for you in your particular circumstance. So I'm going to preface everything I'm about to say that if I could, I would put every client in a solo 401k. Okay. Why? Because you can put away a lot more money, $69,000 or $76,500 if you're over 50. In IRA, just $7,000 or $8,000 if you're over 50. There's a loan feature that lets you borrow $50,000 or 50% of your account value, whatever's less. There is the ability to do a mega backdoor Roth where you can Roth yourself all the way up to $69,000 or $76,500 dollar for dollar. The Roth IRA is only $7,000 or $8,000. And the mega backdoor Roth for a 401k has no income limitations. Even though with the Roth IRA, you can always do the backdoor Roth IRA. There's still some pro rata issues to consider if you have other pre-tax IRAs hanging out. Another great reason is if you are a real estate investor, you are able to use the 401k to do real estate and use a non-recourse loan to acquire real estate, and you will not have to pay a tax known as unrelated business income tax, which can go as high as 37% at a very low income threshold, approximately 15%. So it's a super, super attractive plan. Plus, it's also a bit better in asset credit protection. IRAs are limited to approximately 1.5 million bankruptcy protection and a federal bankruptcy protection. Most states do follow the 2005 Federal Bankruptcy Act. It's unlimited. So when you put it all together, right, you can see the solo K is just a very, very robust and powerful retirement and investment plan, because the solo K can also do alternative asset investments like a self-directed IRA. In fact, with a solo K, there's only two things you can't do. You can't do collectibles, and you can't do 4975 prohibited transactions involving a disqualified person. Same rules as an IRA. Only distinction is with an IRA, you're not allowed to buy life insurance. In a plan, you can. Okay, so you get that added feature of being able to buy life insurance in a 401k, and you can't in an IRA. So why do I have 20,000 plus IRA clients? Well, there's eligibility requirements to get into a solo plan. So you need to have a business. Okay, doesn't have to be a $1 billion business. It's got to be a business. You can be sole proprietor, a single member LC, a C Corp, an S Corp, a partnership, even a charity. You got to have a business. That's the first requirement for eligibility. The second requirement is you can have no full-time employees other than the owners or their spouses. Now, full-time employees means 1,000 hours or more, 3 consecutive years of 500 hours or more. So if it's just you and your spouse, you're good. If it's just you and another partner, you're good. If it's you and you have some independent contractors or maybe some students that work less than 1,000 hours, you're good. But if it's you and you have non-owner employees that work more than 1,000 hours or 3 consecutive years of 500 hours or more, you're not eligible to set up a solo K. Meaning if you want a 401k, you're going to have to do what's called, a regular safe harbor defined contribution plan, which is great, right? IRA Financial has it, Tesla, Apple, most large growing companies have it. The thing is, you're likely not going to be able to do alternative asset investments, right? Because you're a fiduciary, a trustee of the plan. You obviously have fiduciary responsibilities to your employees. And generally, you have to do at least a 3% safe harbor match if you do a safe harbor 401k, and it's 3% of their salary. Now, there's limitations. You could draft the documents where you would only have to do the 3% if the employees contribute to 3%, so it'd be elective. But there are some potential requirements on the part of the employer. Now, with the solo K, it's just you, right? So any benefit you are benefiting from. So any contributions the business makes is going into your pocket, right? So I mentioned with the solo K, you can put away 66 or 69 or 76,500 if you're over 50. The way that works is there's an employee deferral, just 23,000 or 30,500 if you're over 50. And then there's a profit sharing component of up to 20% if you're self-employed or sole proprietor, single member LC, or 25% if you're a W-2. So quick example, if you made 100K W-2 under 50, you can put away up to 23,000 plus 25% of 100, it's 48,000. Now the 25%, that's an employer profit sharing contribution, but you're basically giving the money to yourself, right? Because you own the business. So you're literally taking it from one hand, giving it to the other hand, and your company's getting a deduction. Now, if you had 50 employees and you did a 3 or 4% match, obviously that's cash flow that's coming out of the business, going to your employees. So obviously the solo K, for that reason alone, from a retirement and business standpoint, is very tax and cash flow advantageous. But not everyone has their own business, right? The other reason why the solo may not work is if you have a Roth IRA. Let's say you have a big Roth IRA and you want to do alternative asset investments. You can't move a Roth IRA to a 401k plan. That rule is in flux and it could change. Hopefully, there was rumors it would change in 23. It didn't. It could change in the future. But let's say you had $100,000 or $500,000 in a Roth IRA and wanted to buy real estate, the solo K wouldn't be an option because you couldn't roll the Roth IRA into the solo K. Now, if you said, that's cool, I'll do a Roth IRA for that money, and then I'll do a solo K for some new money because I can add quickly. I can do a mega backdoor Roth, 69,000 or 76,000 from 500 from over 50 dollar for dollar, and within a couple of years I'll get to that number. That works too, but you're not going to be able to use that Roth IRA and transfer it tax-free to a 401k. So, putting it all together, obviously the solo K is just an amazing plan. You can do the same investments plus life insurance. You get the leverage exemption for real estate. You can borrow $50,000 up to $50,000 or 50% of your account value, whatever's less, tax-free, penalty-free. Use it for any purpose. You can use the mega backdoor up to 69K or 76,500 if you're over 50, dollar for dollar. Great asset and creditor protection. You can do employee deferrals, profit sharing, and pre-tax or Roth. Unbelievable, robust retirement and investment plan. But you got to have a business, could be a side gig. You can drive Uber, you can do consulting, you could be a math tutor. I even have a client that's Santa Claus for a few months, makes a couple grand doing it, retired, but he makes a couple grand at a mall each Christmas. He's self-employed, that works. So you don't have to be the next Apple or Google, but you need to have some self-employment income. But if you're listening to this podcast or watching the video on YouTube and you're like, I'm a lawyer, I'm an accountant, I'm an architect, I'm a doctor, or I'm a marketing executive, and I don't have any time to do anything on the side. I got my family, I got my hobbies. I'm W-2, like that's all I am. Then the solo K is just not an option for you. One other wrinkle. If you have real estate income, right, you potentially could set up a solo K. The one thing to remember is you need to be filing as a Schedule C as in Charlie taxpayer and not a Schedule E as in Edward taxpayer. If you move some of the E, which is passive, not subject to self-employment, Social Security tax, to C, yes, you'll have to pay some Social Security FICA taxes on some of that income, but then that income will be eligible for contributions to a plan. And now you'll have a business that you can set up a plan for. So there are some advantages of doing that. But of course, the drawback is there is going to be some self-employment FICA taxes. So that's the main difference between a self-directed IRA and a solo. With the self-directed IRA, you can do a full-service self-directed IRA where the IRA invests directly into the asset, or you can do a check for control self-directed IRA where the IRA owns an LLC. You manage the LLC, and all the income and gains flows back to the IRA without tax, since an LLC is a pass-through entity. But guess what? You can also do a solo K LLC if you want. But the nice thing with the self-directed solo K is it's number one, open architecture, so you can do anything you want. Number two, you're the trustee of the plan, so you don't necessarily need to be the manager of the LLC. You don't need the LLC. You can just, as the trustee, have checkbook control. But you can set up an LLC if you want to have limited liability protection as well. What else? The UBIT exemption for real estate investors is huge. I get multiple calls a day about, Adam, I watch your videos, read your blogs, listen to your podcasts. Like, I'm a real estate person. I'm in an IRA with you. How do I get to the solo? Sometimes there's options, sometimes there's not. It's really if you have side business and can you move some of your Schedule E to Schedule C. If you can, we'll work with you, make it happen. If you can't, so that'll be. It is what it is. So all in all, they're both structures, the self-directed IRA, the self-directed IRA LLC, the solo will let you do alternative asset investments. But the solo K will give you the loan feature. It will give you the mega backdoor. We'll give you the exemption from UBIT for real estate, and we'll give you strong asset and credit protection. The one thing with the solo K is if you have more than 250K, you have to file a 5500 EZ each year. With the self-directed IRA, even if you have $50 billion, IRA Financial as the custodian will handle the 5498s and 1099s. But guess what? We're one of the few IRA solo K providers / custodians that will also file your 5500 EZ for you, and we'll also do any 1099s, and we'll even do the 990T if you have UBIT. So we're a full service. We have flat fees. We don't have wire fees, no transaction fees, no asset valuation fees. You can have one account with us, whether it's an IRA or 401K, and you can do 1 or 50 investments. You're going to pay the same fee. And that's something, obviously very, very proud of. So hopefully now you know the difference between the self-directed IRA and the solo. If you are listening to this, like, hey, this is cool. I want to do real estate. I want to do cryptos. There's basically, as I mentioned, only 3 things you can't do with an IRA: life insurance, collectibles like art, and thirdly, any transaction that directly or indirectly personally benefits you or a lineal descendant, parent, child, spouse, daughter-in-law, son-in-law, or any entities 50% or more owned by such persons. Otherwise, you can do it, right? Same with the solo. The only advantage of the solo is you can do life insurance in the plan. So you can, what's popular, right? You can buy real estate, you can invest in cryptos, gold, hard money loans. You can do private equity, hedge funds, venture capital, private business, private placements, crowdfunding, tax lien, tax deed. Other than those 3 things or 2 things in the case of the 401k, you can do it. I've had crazy people do crazy things like invest in companies in Zimbabwe, Iraqi dinar, Lebanese real estate. Now, I'm not saying you should do that, Venezuelan bonds, but the world's your oyster. You can do almost anything you want. I'm not suggesting people do it, but you can get creative. And on the flip side, I've had clients make money on crazy, crazy things that I don't even understand. But that's the beauty of the code. We're in America. Freedom. We can invest our money and do almost anything we want. Certain investments do require you to be an accredited investor, like private placements or investment funds. Accredited investor is someone who earns more than $300,000, married, filed jointly, or has a net worth over $1 million, excluding primary residence. But putting it all together, I think the solo K trumps the self-directed IRA. But if you aren't self-employed and don't have your own business, can't move a Schedule E to C for real estate, then the self-directed IRA is a great, great fallback option. Don't worry, you can still invest tax-free, tax-deferred, control, diversify, invest in what you know and trust, hedge against inflation, and have some fun. So thank you for listening. If you are watching on YouTube, really appreciate it. If you can provide comments, good review would be great. A thumbs up, a like, all that's really, really greatly appreciated. The more positive feedback, the more the algorithms will boost the podcast and the video. More people get to listen and watch it, which hopefully is what it's all about, right? More people that learn are educated, more people can get rich with the retirement system, which is rigged in our favor. And it's not a zero-sum game. We all can take advantage of compounded returns and get rich. Just need to know about it, educate ourselves, and start learning good habits. So that's what I do, and hopefully you enjoyed it. So appreciate you guys hanging out with me today. Have an amazing rest of your day, and I look forward to seeing everyone again next week. Take care and be well.